But before you do anything else, you'll definitely want to listen to our next presentation. Aegon has done its annual advisor survey, which is always a great barometer of what's going on in the planning profession. What can it tell us about your investment processes and multi-asset in particular? Ladies and gentlemen, I give you Tim Orton.
Morning, everybody. Great to be here to join you today. So I'm going to talk to you a little bit about multi-asset fund investing. So why am I talking about this today? Well, we think multi-asset funds play a significant and increasingly important role in centralised investment propositions. There's a plethora of different strategies out there in the UK market. We counted 710 funds, in fact, in our survey. Now, they've all been through a thorough test in 2020. There's been lots of market volatility. There's been recently changing regulation and increasing demand for lower costs. So we think it's a good time to see how they've fared and what the future may hold. So I'm pleased to be able to share with you today some insights from a recent survey of 250 financial advisors and to give you a few of my thoughts for the future. So why are we interested? Well, at Aegon, we're both a platform provider and a fund manufacturer. We've been managing multi-asset fund solutions for over 35 years now for both financial advisors and in workplace schemes. We believe that they meet a variety of needs and have about 20 billion of assets under management. And that covers over 1 million customers across a variety of multi-asset solutions, including our new risk-managed portfolios. So looking at just some basic data. So from the Investment Association and our own survey data, it's clear that multi-asset strategies are no flash in the pan. There's mixed assets, which is a sector which many multi-asset funds fall into. That's got an 18.8% share of UK funds under management. That's £248 billion worth of assets as at September. And in the retail market, advisors tell us that they account for a third of their assets under management. Now, mixed assets saw net retail sales of 3.8 billion in 2020. That's 28% total sales, second only to fixed income. And if you look at the last 10 years, mixed assets have been in the top two highest selling asset classes consistently. So what this kind of clearly shows us, I think, is that there's a significant ongoing shift, and that's in the marketplace away from single asset class fund picking to focus on products and solutions that deliver client-focused outcomes as a package. Now, looking at our survey, these confirm some of the key reasons why advisors are using multi-asset solutions. The top three probably aren't a surprise. There's diversification of assets. It's pretty obvious, this one, an efficient way to obtain wide market access. Access to expertise from optimal asset allocation is interesting. It's been shown in a range of studies that asset allocation, rather than stock selection, can drive the greatest proportion of returns. And you'll notice that stock selection ranks much lower on advisors' priorities list. But also the need to match a solution to a client's risk profile. And that helps integrate these funds into a consistent advice process. But I think what's also interesting is some of the practical points that come through not far behind. The ability to understand, explain, and use the solutions. This has long been the message from the regulator as important. And of course, delivering clear costs and value for money is always important. It's also interesting, I think, that investment return is actually right down at the bottom. Now, that doesn't mean, I don't think, that performance is not important, but advisors rate the fact that they can rely on the construction of a fund to deliver a risk-return profile to suit their clients' needs, and that perhaps takes away the anxiety for managing performance in such solutions. So, turning to sort of propositions, since the Retail Distribution Review, which is 2012, and more recently MiFID II, we've seen the advisor community continue to evolve their propositions, and many now focus on financial planning, rather than investment management. And that's where many advisors feel they add greatest value to clients' financial futures. With an ever-increasing regulatory focus on suitability, the ease of integrating a multi-asset solution has pushed them to the core of many centralised investment propositions. This is particularly true where charges are constrained by a client's level of wealth. The type of strategy is vital to driving value for businesses, de-risking their balance sheet, and delivering increased operational efficiency. And with increasing attention from the FCA's PROD rulebook, we've seen a lot of centralised investment propositions being reviewed and revised of late. A proposition that's built around a single solution doesn't fit all audiences, so we're seeing more CIPs with multiple solutions designed to meet the needs of different client segments, as we'll see just in a moment. Now, allocation to multi-asset it is influenced by pot size, and this survey shows that the size of a client's savings can have an impact on the strategy chosen. Now, whilst pot size is only one factor here in assessing client segmentation, it does provide a good indication, it seems, of how strategies are used, and you can see that in this chart. Advisors more frequently recommend multi-asset strategies to those with savings below 100,000. I guess that's more likely down to the simple cost-benefit analysis. Multi-asset funds generally easier and more efficient to implement, with less of a cost drag to both the client and the advisor. If you look between 100,000 and 250,000, model portfolios are often chosen. And advisors are more likely to recommend DFM strategies for those with savings above 250,000. I guess simply put, those with larger savings pots are more willing and able to pay the additional investment and advice costs generally associated with these individual services. The general trend here is, I guess, what I would have expected. But what's really interesting is 44% of those surveyed said that pot size was actually irrelevant when deciding whether or not multi-asset strategies were the right option. So irrespective of a client's wealth, if you've got needs that are aligned to a straightforward objective, then a multi-asset solution may be the best fit. So we've looked at the popularity of multi-asset funds and their role in centralised investment propositions. Now let's look closer at the changes in the sector and maybe some of the opportunities that they present. So we're going to look a little bit more about regulation, about market volatility, and the rise of ESG. So, regulation, most recently through PROD and MiFID II, has been reshaping centralised investment propositions. Our survey findings show 59% of advisors said that these regulations have impacted their investment proposition, and a good proportion, around about 20%, have turned to multi-asset funds or lower cost strategies to help meet these demands. So, we think this is because multi-asset funds are a fully formed solution. So opposed to having to start from scratch, make it easier to meet regulatory requirements as they're generally baked in. So looking at a simple checklist of the aspects you might want, you've got clear governed target markets, helping demonstrate how they meet a client's needs, simple measurable investment and risk objectives, straightforward to understand and explain to client solutions, comprehensive reporting, keeping advisors and clients informed, and lower cost solutions, helping to improve client outcomes. Of course, these points don't apply to all multi-asset funds, but increasingly there are ones that do, and it goes a long way towards meeting the regulator's vision here and meeting a client's investment objectives. Now, one factor that varies across multi-asset funds and has been under scrutiny, as well as downward pressure, I guess, is cost. Cost can have a significant impact on the eventual value for investors, and not surprisingly, the advisors we surveyed are clear about this. So 55% stated that costs should reduce further within the market. Now, modern multi-asset funds are well positioned to satisfy this demand. However, I've talked about varying levels of complexity across multi-asset strategies, and with this comes a wide variation in fees. Now, it doesn't mean, of course, that the cheapest always presents the best value. nor does it mean that the most expensive is overpriced. It really is about value, and extra cost is okay as long as the additional benefits are clear. And this might be, of course, improved returns, some sort of volatility dampening, or other attributes such as built-in risk management and governance. An interesting observation, I think, is that of our fast evolving world, there's many long-established multi-asset funds which perhaps once competitively priced are now less so. And there's various new kids on the block that have been launched to appeal to that more cost-conscious and regulatory aware audience. So I'm going to turn to performance now. It's become of no surprise, really. 2020 has been quite a journey for all asset classes, and there's been persistent and at times really quite extreme volatility. Generally speaking, though, multi-asset funds have performed as expected. Now, the chart here shows the maximum gains and drawdowns across various sectors. You've got single asset classes on the left in blue. You've then got, in the purple, diversified multi-asset strategies, followed by absolute returns. So you can see that the purple, the multi-asset strategies, they've not escaped the turmoil, but they've done it with less extreme movements than individual asset classes. And that's exactly what they're designed to do. Now, it's interesting if you look at this chart, the absolute return sector on the right appears to have also successfully dampened the volatility. They've done it pretty well. But at what cost? So looking at longer term performance, and investing very often is for the longer term. In the case of multi-asset investing, the case for these funds still appears strong. Over the 10-year period, you see strategies are delivering healthy enough growth for most client needs, typically 50 to 75% growth there over 10 years, and with much less volatility in global equities overall. The line at the very bottom is the absolute return sector again, and this shows around a 2% annual return, which I think speaks for itself. Looking forward, I think it's likely that volatility is going to continue. It will persist and interest rates will remain pretty low for quite some time. So what does this mean for multi-asset funds going forward? Well, I think if diversification is a strategy to mitigate volatile markets, then multi-asset funds are clearly designed for this territory and will be successful. Those that are focused on the long term, with expert asset allocation and risk management, can continue to provide a compelling proposition in uncertain markets. And in the past, volatility may have driven the advent of complex risk management strategies. I suspect this may not be the case in current climates. The more complex funds have often been more expensive to access and have failed to provide adequate long-term growth across a market cycle. Now, I suspect such strategies will struggle to gain real traction in an increasingly cost-conscious climate. So another consequence of market volatility, of course, is how investors respond to it. How they react can have an impact on the savings outcome. For example, cashing out at the bottom in fear of loss. Now, the chart on the right-hand side here shows that most queries received in the pandemic have been around investment performance and concerns about risk, which is quite logical. And also is logical on the left, firm recommendation from advisors has been to stick to their plan. So what can multi-asset funds learn from such behaviour? As the regulators state, investors must understand what they're investing in and how the funds may behave in different market environments. I argue, therefore, that simplicity here is really helpful with straightforward design, clear risk targets, and robust risk management and governance that can all build confidence with an investor through understanding. Now, the last area I'm going to look at is ESG, environmental and social governance considerations. Now, this is being driven, or the growth in this area is being driven by three key factors. Number one, it's back to regulation. Policymakers around the world are developing new rule books for the ESG sector. They're no longer voluntary regulations, they're getting more rigid, and the market must react to it. There's a view that ESG can potentially bolster returns. There's increasing evidence and belief that companies which adopt sustainable practices can ultimately perform better. And by implication, funds which integrate these factors into their investment process can potentially generate better risk-adjusted returns. And then, of course, there's just increasing demand. The tendency in the past was to put ESG investing down to millennials, but that's no longer the case. There's demand from investors across the board. Public awareness of ESG-related risks has grown. There's a dramatic increase in coverage and support from the media, and global events such as COVID-19 make ESG risks ever more real. Now, I saw a PwC report recently, last month, where assets in sustainable investment products in Europe, they'll reach an estimated 7.6 trillion euros over the next 5 years. And they'll start to outgrow conventional funds, increasing their share of the European fund sector from 15, that's 1.5, to 57%. So what does this mean for advisors? Does it matter? Well, 41% of the advisors we surveyed reported an increase in requests from clients for ESG products. This is definitely coming. Now, we know there's a shift towards multi-asset investing. How do we marry that with the demand for ESG investing? And there are challenges. So as noted on the left-hand chart, there's generally a lack of understanding with investors around ESG and terminology. Given the wide range of options that fall within the definition of ESG, this is really no surprise. There are other considerations too, such as cost, lack of quality data, lack of ESG asset classes in accessible forms, and there's really no standardized benchmarks or meaningful measurement. In practical terms then, broadly speaking, there are two different ways multi-asset funds can approach ESG. You can choose to integrate ESG attributes into an existing investment process. So just aim to have a more positive impact on performance and the environment through doing that. So as an example, we've recently revised one of our default fund ranges by introducing ESG Global Equity Tracker for over 50% of our equity coverage. This has allowed us to improve ESG scores, reduce carbon emission rates, with no real impact on the risk and return profile, and no real impact on cost. Now, our intention is to adopt this approach to other elements of portfolios. But as noted by advisors surveyed, it still can be difficult to apply ESG to all asset classes in an effective and cost-efficient way. Now, the other way really is to take a more direct approach to creating a solution with a more headline-specific ESG objective. So you could target a particular impact, a theme, or some sort of exclusion. Now, these approaches do exist. They do vary a lot, and they may come with greater risk and higher costs. And of course, they won't suit everybody's values. Now, regardless of approach, I think the investment world will continue to evolve and meet this demand and make positive impact on the environment and society more central to what we do. And multi-asset strategies are an ideal vehicle to do this. It's certainly something that we're actively reviewing at Aegon, and there'll be further news to come. So, just to conclude now, all investments, including multi-asset strategies, face pressures from continuing market volatility, regulatory change, and investor demand. And I believe there are three core areas of focus for the future. Number one, it's a simpler way to invest. This really is at the heart of multi-asset funds, to enable us to engage investors, meet regulatory requirements, and ensure value for money. Simple solutions are becoming a clear preference. Value for money itself. Multi-asset solutions should help deliver all the optimal ingredients needed by many within a single solution, whilst keeping costs under control. For strategies that struggle to demonstrate value, they're likely to face continuing pressure to lower their fees. And then ESG integration. Current and predicted level of demand for ESG investments cannot be ignored. Developing ESG within multi-asset strategies is inevitable, and this will become more achievable as value-driven and effective components become more widely available across the asset classes. So within my few minutes with you today, I think I've only given you a flavour of some of the themes that we feel are important to everyone. At Aegon, we believe in providing choice to enable you to meet a variety of objectives. And more complex and expensive solutions, of course, still have an important role to play for certain objectives. But for many, we believe keeping it simple can lead to improved client engagement and ultimately better outcomes for advisors and clients. Well, thank you very much, and I now hand you back.